Welcome back. You're watching Buy Now, Sell Now, and it's time to cut across Tata Capital Management conversations on Q3 results.
Actually, speaking for us, there have been a couple of benefits. One is on the cost of funds coming down, plus we had the IPO. So to the extent we had more liquidity available plus. But strategy there has been to pass benefits to the customers. So if you would notice, our NIM has improved, but not as much as the drop in cost of funds has happened because we've been wanting to pass on these benefits and then spur growth. So to that extent, our margins have improved, but most of the benefit of cost of funds has gone to the customers.
Understood. So the aspiration for you is, and there are tall aspirations. I'm trying to break it down one by one. Credit cost below 1%. You've done 1.2, 1.3 last couple of quarters. What gets you down by another 25%? Because it's 30 bips is large.
So if you would notice, quarter on quarter, our credit costs have been coming down. If I talk about the whole consolidated Tata Capital credit costs have come down to 1.2% from 1.3%. If I talk about excluding motor finance, credit costs have come down from 1.1 to 1% in Q3 over Q2. We do believe that there is an opportunity to further bring down credit costs, and that's the reason we are saying that the credit costs will come down closer to 1% as we move forward.
Timing of that, Mr. Sabharwal?
I just want to say that, the credit cost is a function of the mix of assets that we have. And we have a bias towards housing, which forms about 1/3 of our assets. We are largely secured in nature on the retail side. In SME, we are spread across, multiple products and a lot of clients, and same is true for corporate. So it's the mix of assets which allows us to keep the credit costs low.
Okay. So would you say that the 1% you'll reach that maybe 2 to 3 quarters from now? Will it be linear 10 basis point reduction over the next 2 to 3 quarters?
We do believe that as we move forward, we will be able to bring down credit costs. Our guidance is that by FY28, our credit costs will be below 1%. We expect to be there before that.
Okay. You have a very large base. You're one of the larger NBFCs out there. Your guidance is to grow at 23 to 25%. That means you'll double in terms of your AUM versus FY25 by FY28. How confident are you of getting there? And what are the levers you're using to get there? Because you're well spread in terms of geography. You're also well spread in terms of loan book. So what grows? Is there an additional pillar of growth that you bring in? Maybe something you've not done earlier? Give us a perspective.
So look at the growth which we have been posting over the last 3 years or so. It's been 25% plus. And what we've spoken about that till March 28, we will be able to grow at about 23 to 25%. We do believe that that is possible, and we've been able to demonstrate it in the past and also in the quarters for this year. If you look at our growth, excluding motor finance, it's been about 26% in Q3. We also believe that this is happening because we are present across 25 plus products, present across all segments of the business. In housing, we are there in prime housing, near prime, affordable, LAP. We are present in all segments. Similarly, in retail, we are present across all products. In SME, we have a bouquet of products which we offer. So our spread across multiple products and our presence in over 1,500 branches allows us to take opportunities of all segments where we see growth happening. And that is what is supporting growth. We are well diversified with no large exposure to any particular segment.
Right. And as you grow, just operational efficiency playing out, because you're guiding for cost to income to fall from maybe 38% odd to 34 or sub 34 as well. Is it just going to be operational efficiency, or how does it play out?
So there are a couple of things which help us in this. One is obviously the scale. Scale helps you to bring down our operating cost to asset ratio. The other is that we've been early adopters of technologies and what's happening in terms of the new age technologies. We were amongst the first ones to digitize all journeys. Over the last year and a half, we've been investing a lot in the GenAI space. We've implemented a lot of projects there on the credit side, on the voice analytics, and so on, which are helping us in bring down our cost to average assets ratio. As we move forward, we believe the play of GenAI will become even stronger, and that will also be supportive along with scale in bringing down the cost to average assets.
Okay. And is it just credit cost and cost to assets which will aid ROA, therefore higher to 2.7, 2.8%?
So for us, the play in terms of further improvement in ROAs will happen, one, as you mentioned, on credit costs, two, on operating efficiency. Third, we do believe there is an opportunity for us to further improve our NIM plus fee, and that is going to happen more by increasing the proportion of high yield products in our portfolio. As that proportion is growing with every quarter, as they further scale up, we believe it will also give us a positive fill up on the margin side.
Your promoter, sir, owns above minimum public shareholding. Will the dilution happen through a likely sale, or will it just be a dilution through fresh issue, in your opinion?
The capital which we raised as of our IPO will support us till about the first quarter of the calendar year 28. Post that, we will be needing more capital for growth. We will obviously be in the market, but the way it will play out will finally be decided by the board at that point of time.
All right, that was the management of Tata Capital weighing in on the Q3 earnings. But with that, it's time for us to slip into a short break. Don't go anywhere. After the break, we'll come back and start taking your questions with our experts, so stay tuned.